Okay, let's really dive into this. Imagine for a moment a country that spent decades with its economic doors, well, mostly shut to the rest of the world.
Right. Carefully guarded its currency, limited trade.
Yeah, and viewed foreign money and companies with a degree of suspicion,
Mm.
prioritizing self-reliance, insulation.
Hmm. So, what happens fundamentally when that country decides, okay, it's time to open those doors? Not just a crack, but like swing them wide.
How did its currency change? How do its own companies start operating on the global stage?
Mm.
And, what does that mean for its place in the international economy?
Well, that transition, it isn't just a simple flick of a switch, is it? It's a profound transformation. It reshapes nearly every aspect of an economy.
Really? Like, specifically?
Well, it impacts everything from, say, daily transactions involving foreign currency, right up to how major corporations access the capital they need to grow and compete globally. It's a move from a system built on control to one built more on facilitation and management.
And that journey, specifically India's incredible economic opening starting in the early 1990s, that's exactly what we're deep diving to today.
Yep. We've got this fascinating source material excerpts from a book that really zeroes in on the Indian economy, looking particularly at the dramatic shifts in its trade policies and, critically, its foreign exchange management.
So our mission in this deep dive is to take this dense, important information and, well, unpack it for you.
We want to extract the core knowledge, understand the driving forces, the why behind these changes, and the practical how they were actually implemented.
Right. We'll look at the dramatic shift from those older, highly restrictive rules to a much more liberal framework.
And get a solid grasp on a crucial concept called rupee convertibility.
Yeah, that sounds important. And also explore the specific ways Indian businesses began to engage with international financial markets.
Think of this as your essential shortcut to understanding a truly pivotal moment in India's economic history, drawing directly from the insights and details presented in this source material.
So let's not waste any time. Let's dig into this stack of information and uncover the key insights and maybe surprising facts that tell the story of India's path towards global integration.
Okay, so to set the scene, the source takes us back to the period right after India gained independence. It notes that the country adopted relatively protectionist trade policies post-independence.
Right. Relatively protectionist. What did that actually mean in practice?
It meant the focus was heavily inward-looking. The priority was building domestic industry, limiting foreign competition, and generally keeping the economy somewhat insulated from the fluctuations and pressures of the global market.
Gotcha. And you'd need a legal framework to enforce that kind of insulation, right? Especially when it came to money crossing borders.
Exactly. And that's where something called FARA came in.
FARA. Okay.
Yeah, the Foreign Exchange Regulation Act, first enacted back in 1973. The source is quite explicit about FARA's character. It describes it as restrictive and highlights its stringent regulations on foreign exchange transactions.
You can almost hear the emphasis on control, just in the name itself, Regulation Act.
Totally. And as the source details, the fundamental purpose of FARA, especially within that context of a closed economy with strong insulation from the rest of the world, was to actively discourage foreign currency in domestic economy.
So foreign money wasn't seen as something to be freely circulated or easily accessible.
Precisely. The material highlights that under FARA, any transaction involving foreign exchange was very limited. If you wanted to do anything with foreign money, more often than not, you had to seek approval.
It wasn't a default yes unless,
Oh.
more like a default no unless you get permission.
That's a good way to put it, yeah.
Yeah.
And it went further than just needing permission for certain things. There was a large number of transactions in the negative list.
The negative list. What was that?
These were things you simply were not allowed to do with foreign exchange, period. No ifs, ands, or buts. It really hammered home that sense of strict control and limitation. The source notes that cross-border inflows and outflows were also restricted, which, again, was perfectly aligned with that broader strategy of insulation of the economy, keeping things locked down.
And this level of oversight, this suspicion almost, it extended even to companies operating in India.
It did. The source points out that foreign-owned companies were given a specific designation. They were called FARA companies.
FARA companies. Okay.
And much like MRTP companies under a similar act regulating domestic monopolies and restrictive trade practices, these FARA companies were closely monitored and regulated.
Why? What was the stated reason?
The source says it was for fears of exploitative and unethical practices. You can really feel the underlying caution and, well, vigilance towards foreign economic activity back then.
So FARA was powerful then. It
Yeah.
wasn't just guidelines.
Oh, definitely not. The source even notes it vested powers to try out criminal cases of violations in foreign exchange regulation.
Criminal cases, not just fines.
Exactly. Violations weren't minor civil penalties. They could land you in criminal court. This tells you just how seriously the government at the time viewed adherence to these foreign exchange rules.
Okay, so that paints a pretty clear picture of the before an economy operating under the tight grip of FARA, prioritizing insulation and control over foreign exchange.
That's the setup.
Okay, that's the setting. Now, the source pivots to the big moment, the early 1990s. It tells us that India embarked a massive and serious trade liberalization measures post-1991. This was a seismic shift we talked about earlier.
Right, and the driving force, the catalyst for this massive change. The source directly links these reforms to being necessitated as a response to the concerns of the globalization and integration of Indian economy with that of the world economy.
So the world was changing, becoming more interconnected.
Yeah, and India recognized it needed to adapt to participate effectively in the global economy, not remain, an isolated island.
The source lists a whole range of measures that were part of these trade reforms. It shows just how comprehensive they were.
It does. And while there are many, you can really see the theme: reducing barriers.
Like what?
Things like the removal of quantitative restrictions on imports, meaning those physical limits on how much of a certain product could come in, were lifted, and a significant reduction in import tariffs, which lowered the taxes on imported goods, making them cheaper.
So easier to bring goods in. But it wasn't just about removing restrictions, was it?
No, absolutely not. The source also mentions measures to actively promote trade and foreign investment, things like setting up special economic zones, SEZ scheme, and export-oriented units, EOU scheme.
Ah, yes, SCZs and EOUs,
Not-
designated areas to make exporting easier.
Exactly, more competitive. There was also sectoral deregulation, opening up various parts of the economy that had been restricted before, and specific concessions and exemptions to facilitate certain types of trade and investment.
What else? The list seemed quite long.
It was. Other measures included promoting the growing services sector with promotion of service exports, creating agricultural export zones, setting up specialized trading houses, and implementing a market access initiative to help Indian businesses enter foreign markets.
And they also undertook a devaluation of rupee, right? What does that do?
Well, devaluation makes Indian exports cheaper for foreign buyers, hopefully boosting exports, and makes imports more expensive for Indian buyers, potentially reducing the import bill.
Okay. And a rationalization of tariff structure, just simplifying things.
Pretty much, simplifying the complex import duty system. It was a whole package.
And crucially, among this list of trade reforms, the source includes the convertibility of rupee on current account. That sounds technical, but important.
Oh, it's major. It's a key part of easing foreign exchange controls, and yeah, we'll definitely dedicate significant time to unpacking that one shortly. So all these steps together represent a deliberate, wide-ranging move away from that earlier protectionist model. Absolutely, and the source makes a really key point here. These trade reforms have their genesis in repealing of the Foreign Exchange Regulation Act, FERA 1973.
Ah, so you couldn't truly open up trade while the old law restricting foreign exchange was still in place.
Exactly. The old foundation had to be removed to build a new, more open structure. You couldn't have both operating effectively.
So FERA was repealed. What replaced it?
In its place came a new law, the Foreign Exchange Management Act, FEMA, enacted in 1999.
FEMA.
Okay. And the source highlights that this wasn't just a simple name change or a minor update. It was, in its words, a major paradigm shift in the government's outlook towards foreign currency.
A paradigm shift. That's strong language.
Yeah.
How was the philosophy different? What did that shift actually mean?
Well, the core difference, according to the source, is that FEMA replaced regulations with management. That's the key phrase.
Regulation versus management. Okay.
So instead of a law focused on rigidly regulating and restricting foreign exchange transactions, the new act was about managing the environment in which those transactions occur.
Right. Less about stopping things, more about guiding them.
You got it. This fundamental change in approach meant FEMA was designed to be more liberal and allowing transactions without restrictions. It dramatically pruned the negative list. Remember that list of things you couldn't do?
Yeah, the forbidden list.
Well, under FEMA, that list got much, much shorter, meaning far fewer things were outright prohibited when it came to foreign exchange.
That pruned negative list sounds huge. It signifies a move from a mindset where most things were restricted unless explicitly permitted.
To one where most things were permitted unless explicitly restricted. Yes. The source captures this perfectly by saying the basic idea was to permit rather than the earlier regime to prevent.
A shift from guilty until proven innocent in foreign exchange dealings to more of an innocent until proven guilty approach, maybe.
That's a fair analogy, I think. And this signaled a broader change in India's stance towards the global economy. FEMA eased restrictions on cross-border capital flows, especially foreign investment.
Which the source describes as providing a clear signal of lowering of insulation. India was basically saying, we're open for business.
Exactly, welcoming foreign capital. A stark contrast to the FARA era.
And as part of this broader reform package, the source also mentions that the MRTP Act, the one regulating domestic monopolies, was dismantled alongside FARA.
Right, which meant those specific designations and the intense monitoring applied to FARA companies and MRTP companies became obsolete. Things were simplifying.
Now, with the focus moving from treating general foreign exchange stuff as potentially criminal under FARA to more of an administrative management approach under FEMA, what happened to the criminal enforcement part?
Good question. The source notes that the power for trying out criminal offenses specifically related to foreign exchange violations was entrusted to a separate, newly created enforcement directorate, ED.
Ah, the ED. So they handle the serious stuff.
Yes. FEMA provides the legal framework for managing foreign exchange generally, but the serious criminal investigations and prosecutions are handled by this specialized body. It separates the day-to-day management from pursuing deliberate financial crimes.
Okay. So to sum up the scope of FEMA, based on this material, the source identifies three broad areas it covers.
Yeah, three main buckets. First, rupee convertibility, which, as we said, we'll explore in depth next.
Right.
Second, setting up of a separate ED for trying out criminal offenses in foreign exchange. We just touched on that.
Got it.
And third, borrowings by the corporate sector, meaning how Indian companies can access funds from overseas markets. Another key area we'll unpack.
Okay. So clearly the move from FARA to FEMA wasn't just legal housekeeping. It sounds like it was a fundamental shift, underpinning the broader trade reforms and marking India's big step towards greater openness.
Absolutely. It set the stage for everything that followed in terms of global integration.
Okay, let's zoom in on that first key area covered by FEMA. Rupee convertibility. It sounds technical, but you said it has massive implications.
It absolutely does. The source gives us a great starting point for understanding convertibility by placing it in context. It says convertibility goes with open economies and little relevance in the era of closed economies.
So back in the FARA era, with everything tightly controlled, the concept didn't really apply much.
Exactly. Because nothing was really convertible freely anyway.
Got it. So at its heart, what does convertibility actually mean?
The source defines the core meaning as being able to treat foreign currency no different from the home currency for transaction, investment, and saving purposes, whether in the domestic economy or overseas.
Okay, so treating dollars or euros just like rupees, basically, for lots of different things.
Pretty much. Think about the US dollar or the euro. For most purposes, you can easily exchange them, use them for transactions, invest them, hold them in bank accounts both domestically and internationally without significant hurdles. That's convertibility in action.
So it's linked to the absence of restrictions from the government of conversion of one currency into another, and also in its end use domestically or internationally.
Yes. And the source uses a great phrase for this. It means the government or the RBI does not ask why foreign currency is required.
Ah, the why test.
Exactly. That why test is central to the old non-convertible regime, and convertibility means it's largely gone. Or, put another way, foreign currency is freely available across the counter like home currency.
Makes sense. And the source gives us a list of practical freedoms that come with convertibility. What does it actually let people and businesses do?
Yeah, it lays out the practical implications. For residents, for individuals like you, it means the freedom to maintain home currency or foreign currency denominated bank accounts. You could potentially hold dollars or euros in a bank account right there in India.
Wow. Okay. What else?
It also means the freedom to residents to remit outside the country, so sending money abroad easily for various purposes, and importantly, the freedom to residents to invest in the global stock markets.
So I could buy shares in, say, Apple or a European company directly from my Indian brokerage account without jumping through hoops.
That's the idea behind full convertibility, yes. much simpler foreign exchange procedures.
And for businesses, for the corporate sector.
Convertibility brings significant flexibility there, too. There's the freedom to domestic companies to borrow funds either from the domestic or from the international markets. More options for funding.
And they can issue shares overseas.
Yes, the freedom to companies to issue shares bonds in overseas markets, though, as the source notes, this is still subject to relevant regulatory compliances. It's not a free-for-all, but the currency aspect is easier.
Beyond just raising money, what about operations?
It means the freedom to domestic companies for global operations and also to acquire companies overseas. If an Indian company wants to set up a subsidiary in Germany or buy a firm in the UK, the currency conversion becomes much less of a barrier.
So overall, more freedom to transact and invest globally.
Pretty much. You gain the freedom to do transactions in any currency and the overarching freedom to invest globally. The source sums it up as the freedom to exchange currencies like commodities across the counter.
Like you can in the US or Europe, where they have convertible currencies already.
Exactly. That's the reality in most of the larger economies, such as US and Europe, allowing this kind of seamless interaction with the global financial system.
Okay, so with all those freedoms, why is convertibility considered so important for open economies? What are the benefits that drive countries towards it? The source must elaborate on this.
So it does. It lists several compelling reasons. First, and quite practically, with the massive increase in global trade and capital flows we see today, the absence of convertibility is seen as a hindrance to smooth inflows and outflows.
It just slows things down, creates friction.
Exactly. If every transaction involving foreign money requires approvals or involves complex procedures, it causes avoidable delays in conversion, besides increasing transaction costs. It's just inefficient in a world that's so interconnected.
And there's a functional asymmetry too, isn't there? The source pointed that out.
Yeah, that's a key point. A convertible currency is acceptable in a non-convertible economy, USD in India, but a non-convertible currency is not acceptable in a convertible economy, rupees in the US.
So having a convertible currency gives it more usability, more leverage on the global stage.
Absolutely. It lacks that handicap.
Mm-hmm.
From a broader national perspective, convertibility is also seen as signaling the growing stature of the home currency gaining global acceptability.
Like a badge of honor almost.
Sort of. And it also reflects greater transparency in the foreign exchange transactions within the domestic economy, which can improve confidence for both domestic and foreign players.
It's also often viewed as a sign of an economy's health and maturity, right?
Yes, the source calls it a sign of growing maturity and strong macroeconomic fundamentals, indicating the economy has the ability to withstand adverse global fallouts. It suggests a level of robustness.
Robustness meaning the free movement of money won't cause a domestic collapse.
That's the underlying confidence, yes. The belief that convertibility will not result in outflows from the economy that cause instability. It's also broadly believed as a way to attract foreign investment because investors, naturally, prefer to bring in and take out money freely.
Makes sense. And efficiency. Competitiveness.
Economies with convertible currencies are generally seen as having greater levels of efficiency, providing depth to the financial sector and being more globally competitive. Convertibility allows for testing of strengths of economies in their bid to global integration.
Testing strengths. Interesting.
And perhaps a less discussed benefit, but one mentioned by the source, is that convertibility is also about dispelling the fear factor, the fear of what if from the minds of the government, moving beyond that apprehension of losing control.
Okay, so that's a compelling list of advantages. But surely there are risks. Convertibility can't be all upside. The source doesn't shy away from those, does it?
No, not at all. And this is critical. The source explicitly warns about the possible fallouts of convertibility. One major historical concern is vulnerability.
Vulnerability how?
It notes that all the crisis-ridden economies in the past had complete convertibility, which exposed them and made them vulnerable, especially in adverse global circumstances. Think about the Asian financial crisis in the late 90s. Countries with open capital accounts faced massive capital flight.
Right, I remember that. And you mentioned something called the Dutch disease. That sounds ominous.
It's a famous economic concept, yeah. The source uses it to illustrate a specific fear. The term came about in 1977 after the Netherlands found large natural gas reserves.
Okay.
The surge in foreign currency earnings from gas exports led to a strong appreciation of the Dutch currency, the guilder. Now that sounds good, right? Strong currency.
Yeah, seems like it.
But It made other Dutch exports, particularly manufactured goods, much more expensive and less competitive internationally. Ultimately, it harmed that sector and slowed overall economic growth.
Ah, so the Dutch disease fear with convertibility is that large, unchecked inflows could make the currency too strong, too fast, hurting exports.
Precisely, that's the fear of infamous Dutch disease.
Convertibility also significantly impacts a central bank's ability to manage the economy, doesn't it? The source brings up the concept of the impossible trinity.
Yes, the impossible trinity. This is a fundamental concept in international economics. It basically states that a country cannot simultaneously have three things. One, an open capital account, which full convertibility implies.
Oh.
Two, a fixed exchange rate. And three, an independent monetary policy, meaning controlling its own interest rates to manage domestic inflation or growth.
You can't have all three.
Nope. The impossible trinity means you can pick two, but the third is constrained by the other two. With an open capital account due to convertibility, a central bank is forced to choose
Choose what you want.
between managing its exchange rate, keeping it stable, or at a desired level, or maintaining control over its domestic interest rates. If it tries to control both with capital flowing freely, large capital flows will just overwhelm one of those targets.
And large capital inflows, even if sometimes desired, can cause domestic problems too.
They can. The source notes they can create issues of liquidity in the banking system, essentially. Too much money sloshing around. And this can result in inflationary pressures, pushing up prices, besides potentially affecting the growth rate in undesirable ways.
And the flip side of inflows,
Outflows.
the fear of capital flight.
Exactly. That fear factor includes the apprehension of flight of capital. This is the sudden, massive outflow of money, often triggered by a loss of confidence or some external shock. As the source notes, this can be very destabilizing in nature for the economy.
How so?
It can drain foreign exchange reserves, cause currency crashes, and trigger broader economic crises. It's a major risk associated with open capital accounts.
Finally, the source makes a somewhat philosophical point about the journey towards convertibility itself. Calls it a one-way journey.
Yeah, offering no scope of experimenting or going back. The idea is once you start opening up the capital account, the source believes it will also have to be completed.
Why? Why can't you just reverse course if things get tricky?
Well, the reasoning given is practical. Over a period of time, it will not be possible to prevent leakages despite having controls on capital flows. The global financial system is just so vast and interconnected that trying to maintain strict partial controls on capital flows indefinitely becomes increasingly difficult and ineffective. Money, eventually, finds ways around the barriers.
Okay, so clearly, moving to convertibility has significant benefits, but also substantial risks. This raises the question, what does an economy need to have in place to be ready to manage those risks?
The source touches on this. It notes there isn't a single universally defined checklist. The requirements are somewhat qualitative and differ based on the specific economy. But drawing from global experience, it lists some key fundamental prerequisites.
Like what? What's on the checklist?
First and foremost, the economy should be on a sustained upward growth trajectory. You need underlying economic strength.
Makes sense.
Secondly, exports should be showing buoyancy, not just growing in volume, but ideally moving away from primary to manufactured goods. This indicates a more sophisticated, higher value export base, which tends to be more resilient.
What about inflation?
Domestic inflation levels should be manageable, and crucially, there needs to be confidence on their ability to be able to effectively manage inflation through appropriate policy tools. You need assurance that opening up won't just let prices run wild.
And interest rates.
Ideally, domestic interest rates should be globally aligned so that capital inflows and outflows are, as the source puts it, interest rate neutral. Money should be flowing because of real investment or trade needs, not just chasing slightly higher interest rates across borders, which can be destabilizing.
What are the country's balance with the rest of the world? Like the current account deficit?
Right. The current account deficit, basically earning less internationally than you spend, should be supported by capital inflows, like foreign investment, rather than requiring the country to take on excessive external borrowings just to cover its basic international transactions. A large, unsustainable deficit funded by debt is a major red flag.
And the government's own finances? Fiscal deficit.
Absolutely critical. You need manageable levels of fiscal deficit. The source stresses the government should be resolved at lowering the levels of fiscal deficit and should have initiated fiscal consolidation. High and rising government debt makes an economy vulnerable, especially with open capital flows.
Need to be able to pay your international debts too, right?
Yes. Confidence in the country's ability to service the external debt through export earnings is essential. Can you actually earn the foreign currency needed to pay back your international loans?
And the health of the financial system itself. Banks.
Hugely important. The source emphasizes that the financial sector, especially banking, should have strong balance sheets, mature, competitive, and have the depth to assess and mitigate risks. They need to be practicing prudential lending, not being overexposed, and have a balanced asset portfolio. A weak banking system is highly susceptible to the volatility that can come with open capital flows. It can amplify crises.
And finally, it loops back to the start, doesn't it? The overall reform process.
It does. The economy should have already initiated economic reforms, greater openness towards competitive, efficient, market-determined, and productive domestic economy. Convertibility works best when the underlying domestic economy is already strong and market-oriented, not heavily controlled and inefficient.
Okay, so that's the theoretical readiness checklist. A lot of things need to be in place. Where does India stand currently on rupee convertibility based on this material? How has it approached this?
Well, the source characterizes India's approach as cautious, well-calibrated, well-thought-out, and gradual, beginning since 1994.
Cautious, calibrated, gradual. So a deliberate, phased opening rather than a sudden leap.
Exactly. And significantly, it notes that there has no fallouts in the journey so far, which seems to endorse this gradual approach as having successfully avoided the kind of crises we talked about earlier.
Okay, so what's the current status then? Where is India now on this journey?
The current status is quite clear, according to the source. India has complete convertibility on the current account in the balance of payments. This was a major step completed some time ago.
Complete convertibility on the current account. Okay, break that down. What does that mean precisely for everyday transactions or for businesses involved in trade?
It means that for the vast majority of normal day-to-day international transactions related to goods and services, think things like paying for imports, receiving payment for exports, paying for international travel, education fees, medical treatment abroad, sending remittances for family support.
The common stuff.
Right. For those standard current account purposes, transactions in foreign currencies are unrestricted and do not have any restrictions either from the RBI or from the government. That Y test we mentioned, it's gone for these things.
So it's generally free and open for trade and services. But are there any exceptions the source mentions for these current account transactions? Still some controls.
Yes, there are a few specific, notable carve-outs from this general freedom, which the source lists, things that are still restricted or require approval.
Like what?
For example, outward remittance of prize money earned out of game shows, lottery, betting, racing, etc. is not permitted. So you can't take winnings from domestic gambling or games and freely send them abroad in foreign currency.
Okay, that's specific. What about something more common, like tourism?
For outward tourism, an Indian resident can freely take up to USD 10,000 per visa holder in a calendar year. That amount is available without needing specific permission.
What if you need more than $10,000 for your trip?
Then prior authorization of RBI would be required, so there's a limit for automatic approval.
And education or medical expenses overseas? Similar limits.
A higher limit applies there without restriction. Up to USD 100,000 is unrestricted for education abroad and overseas medical treatment. But again, if you need more than that, beyond requires prior authorization from the RBR.
Okay. Any other specific restrictions mentioned?
Yes. Payments for foreign artists performing in India or for cultural tours by Indian groups going overseas. The source notes that all foreign currency payments made to foreign artists in India and that required for cultural tours overseas require prior authorization of Ministry of Finance, Government of India. These seem to be areas where the government retains specific oversight.
Right. And it's important to clarify, as the source does, that for these specific transactions not on the unrestricted list, it doesn't mean they cannot be done, right?
Correct. The absence of convertibility does not imply that transactions cannot be done. It just means that such transactions require prior authorization from either the RBI or the government. You have to go through the approval process, which is kind of a remnant of the old permission regime for these specific items.
Okay, so current account convertibility is largely complete, but these exceptions show where some degree of control is still deemed necessary.
Exactly.
Okay, that covers the current account. What about the other big P6, capital account convertibility, or CAC? This is where money moves for investment purposes, right? Buying assets abroad, foreign investment coming in.
Yes, that's the capital account. And the source states definitively about India's current status. Presently, India does not have CAC.
No formal CAC.
This is a key distinction from the current account. Now, there have been many suggestions for moving towards it from various experts committee from time to time. The source highlights that the most notable has been the Terraport Committee recommendations.
The Terraport Committee, what was their approach? Did they recommend going for full, immediate convertibility?
No, not exactly. The source notes the Terraport Committee gave a roadmap of fuller convertibility. Note the word fuller, not full.
Fuller convertibility, what's the difference?
It meant easing restrictions on the capital account gradually over time, step by step. But significantly, the committee has remained silent on the issue of full convertibility. Even their roadmap didn't explicitly call for the complete, absolute removal of all capital controls eventually. It was about moving towards greater openness, but perhaps retaining some controls indefinitely.
That's an important nuance. So India doesn't have formal CAC, but the source mentions the government has been easing restrictions on the capital account anyway, even without the formal label. How so?
Yes, and this is where it gets really interesting. The source points out that even without a formal CAC declaration, the government has, however, gone ahead with the easing of restrictions on the capital account.
Okay.
And there's a crucial asymmetry mentioned here. At present, all inflows in foreign currency, irrespective of the nature, are completely convertible.
Wait, hang on. All inflows. Foreign money coming into India is completely free to convert.
That's what the source states, yeah. It emphasizes there are no restrictions either by the government or RBI on any kind of inflows or their reversal as outflows.
So if a foreign company wants to invest in India, or if someone wants to buy Indian stocks from abroad, bringing the money in is unrestricted.
Seems so, based on this text. Whether it's foreign direct investment, portfolio investment, whatever, you can bring the foreign currency in and convert it to rupees freely. And crucially, their reversal as outflows is also unrestricted. So if you brought dollars in, invested, made a profit, you can take those dollars or equivalent back out freely.
Okay, that sounds like a huge opening compared to the FARA era. So if inflows and the reversal outflows are free, where are the restrictions on the capital account still concentrated?
The primary restrictions remaining, according to the source, are on outflows arising out of conversion of rupees into foreign currency by Indian residents, Indian companies, Indian financial institutions for overseas transactions.
So it's about us, Indian residents or companies, converting our rupees into foreign currency to then send or invest abroad. That's the controlled part.
That seems to be the main focus of the remaining capital account controls, yes.
But even here you said there's been easing. It's not completely blocked.
Correct. The source notes that recently the government has considerably eased restrictions on such transactions on the capital account. It specifically mentions that Indian residents can now freely remit up to USD 2,000 in a financial year overseas without any restrictions for any investment purpose.
Wow. USD 200,000 per person per year for overseas investment. That sounds like quite a lot.
It is a significant amount. However, and the source includes an important update or caveat here, in view of the recent rupee turbulence, it has been brought down to USD 75,000.
Okay. So the limit can change. It got reduced.
Yes, this tells us two things. One, the limit isn't fixed. It can fluctuate based on economic conditions, specifically currency stability. And two, at the time this source was written, that limit had been temporarily reduced from the higher figure.
That fluctuation itself really demonstrates the government's active management approach under FEMA, doesn't it? They can tighten or loosen the taps as needed.
Absolutely. It shows the policy isn't rigid, it's responsive. The source also mentions other relaxations for residents, like allowing them to open foreign currency accounts in India for foreign currency earned for services rendered overseas.
What are those called?
Foreign currency Indian residents FCIR accounts. They let you keep foreign currency you earn internationally, perhaps from consulting or freelance work, without having to convert it back to rupees immediately if you don't want to. More flexibility.
And Indian mutual funds can invest globally now, too.
Yes. The source notes that Indian mutual fund managers have been permitted to invest a substantial amount, up to USD 5 billion in total, in global stock markets. This gives ordinary Indian investors indirect access to international equity markets through their mutual fund investments.
Okay. And we're going to talk more about how Indian companies access global funds next, which is another major area of eased capital account outflows, I assume.
Precisely. So, given all this easing, especially on inflows being free and significant relaxations on outflows, the source draws a crucial conclusion.
Which is?
That even without having SEC, rupee is virtually convertible except that it is not formal declaration.
Virtually convertible, but not formal. What's the practical difference if it walks like a duck and quacks like a duck?
Well, the key practical difference highlighted is control and flexibility for the government. Because it's not a formal, legally enshrined capital account convertibility regime, the government today has a choice of going back and can choose to reimpose restrictions on these kinds of transactions at any time.
Ah, so they keep the option to tighten controls again if needed.
Exactly. If the economic situation deteriorates severely, maybe a global crisis hits, the government retains the legal power under FEMA to tighten those capital outflow controls again, like we saw with the reduction in the remittance limit. A full, formal CAC might make such a reversal much harder, perhaps even legally impossible, depending on how it's implemented. India's current policy allows for more flexibility in managing potential instability.
This brings us squarely to the debate then. Should India take that final step, formally announce and move towards full capital account convertibility? The source presents arguments on both sides, right?
It does. Let's look at the arguments against rushing into full convertibility right now, based on the source. One argument is simply that, at present, there are no apparent compulsions for the government to announce complete convertibility.
Meaning, why fix it if it ain't broke? Or at least if the current system is working reasonably well.
Kind of. What's often the main driver for countries seeking full CAC? Attracting foreign inflows. But the source notes this goal is being served especially in the last 2 years relative to when it was written, meaning inflows are happening anyway under the current virtually convertible setup. Also, it argues India's global stature is not affected even without complete convertibility.
And the source brings up a major counterexample here, doesn't it? China.
Yes, the China example is heavily emphasized. The source argues that China has broken the myth of inflows linked to convertibility, and also the idea that openness not possible without convertibility, or that convertibility and global competitiveness go together.
How has China broken that myth, according to the source?
Well, the source describes China as the fastest growing and expanding economy of the world, with robust exports, sitting on a trade surplus, and globally competitive. All the signs of a major economic power. And critically, it highlights China's experience with capital inflows. Sizable inflows into their economies of over USD 500 billion in the last 2 decades. And if Hong Kong is included, it will go over USD 1 trillion, all without any convertibility.
Wow. Over $1 trillion in foreign investment without full capital account convertibility.
Exactly. That's the point the source makes. It concludes that the Chinese experience has diluted the importance and relevance of convertibility for open economies. It suggests that being globally integrated, competitive, and attracting massive capital isn't necessarily dependent on having a fully convertible capital account.
And India's own experience supports this, too.
To some extent, the source adds that even India, despite not having CAC, particularly after 2007, there has been sizable inflows, including foreign direct investment. So India's own experience after the global financial crisis also shows that significant capital inflows can happen without formal CAC.
Okay, that's a strong argument against feeling pressured to rush into full CAC. But what about the arguments for convertibility being inevitable, as the source suggests? Why might it have to happen eventually?
The arguments for inevitability center more on the long-term trajectory of an integrating economy. The source suggests that, over a period of time with a more balanced global economy, convertibility would be seen as a sign of maturity, resilience of economies with strong macro fundamentals, allowing smooth integration within the global economy. It's about reaching a certain stage where it becomes a natural, expected step.
And there are practical reasons tied to increasing openness, too, right? Like leakages and costs.
Yes. The source argues that lack of full convertibility also allows for leakages, conversion of good money into bad money, implying that maintaining controls can sometimes lead to unofficial or less transparent ways of moving money around those controls. It's also seen as a hindrance to the increasing cross-border flows that characterize a globalized economy. It just adds friction. And fundamentally, it raises transaction costs of conversion as more and more international transactions occur.
And that point about controls becoming ineffective over time, that seems key to the inevitability argument.
It is. The source states that India, unlike China, fortunately has initiated the journey of easing capital account restrictions already. This means, in the source's view, India faces the compulsions of completing the journey at some time.
Why the compulsion?
Because, practically speaking, eventually, the controls would become ineffective or outflows would have to find a way around the controls. As the economy grows, becomes more complex, and more deeply interconnected with the rest of the world, trying to maintain selective controls on capital outflows just becomes increasingly difficult to enforce effectively. The argument is that the leaks will eventually overcome the dam.
So putting both sides together, no urgent compulsion now, but a seemingly inevitable long-term path. What's the source's final take on this debate? When will India get full CAC?
The source's conclusion is quite direct. Full convertibility of the Indian rupee can be delayed, but is inevitable, and the only issue is by when. It accepts the inevitability, but leaves the timing wide open, dependent on circumstances and readiness.
That's a powerful statement about the direction of India's economic journey. Okay, let's move on to the third major area, FEMA, and the post-reform era changed. How Indian companies access global funds. This seems absolutely critical for their growth and ability to compete internationally.
It really is. The source highlights this as a major aspect of FEMA and trade reforms is also the easing of restrictions on the private corporate sector to borrow from the international market.
And why is this so important for companies? What's the main benefit mentioned?
One key reason given is practical, especially for paying for its imports and saving on the transaction cost of converting rupees to foreign currency for import of goods. Think about it. If you're an Indian company buying machinery from Germany priced in euros, being able to borrow euros directly from an international bank saves you the hassle, the cost, and the exchange rate risk of converting huge amounts of rupees into euros first.
Right, borrowing the currency you need to spend in. Makes sense. And this international borrowing by companies is formally known as external commercial borrowings, or ECBs.
Correct. The source describes ECBs as similar to domestic borrowing, except that they are in foreign currency from the overseas market. So instead of taking a loan in rupees from, say, SBI or HDFC, you're taking a loan in dollars, euros, yen, whatever, from an international lender like HSBC or Citibank.
What's the big draw for companies to do this? Is it just about avoiding conversion costs?
That's part of it. But a major advantage, as the source points out, is that it allows companies to take advantage of the interest rate differential between the domestic and international rates of interest.
So it might be cheaper to borrow overseas.
Often, yes. Interest rates in major developed economies have historically been lower than in developing economies like India. So borrowing overseas, even after accounting for fees and risks, can simply be cheaper for Indian companies.
Okay. And how are those international interest rates for ECBs determined? Is there a standard benchmark?
Yes. The source explains that interest rates on ECBs are typically linked to LIBOR, the London Interbank Offer Rate. Now, LIBOR itself is being phased out, but the principle remains. It was described here as a market-determined rate, the floor level of interest and benchmark for global interest rates.
Okay, so a benchmark rate,
Yeah.
and then companies pay something on top of that.
Exactly. Companies then pay a markup over LIBOR, or its replacement benchmark. This markup is usually quoted in basis points, BP says, where 100 basis points equal 1 percentage point. So if LIBOR was 1%, a company might borrow at LIBOR plus 200 BPs, meaning a total rate of 3%. This markup reflects the specific risk the lender sees in lending to that particular borrower.
So who decides that markup? How is the risk assessed? What determines if you pay LIBOR plus 100 BPs versus LIBOR plus 300 BPs?
Good question. The source explains that the markup is decided primarily by credit ratings, sovereign rating of countries first, and then the companies.
Sovereign rating, the rating of India itself.
Yes, these ratings are assigned by major international rating agencies such as Moody's, Standard & Poor, and Fitch. They assess the creditworthiness, the risk of default for both entire countries, sovereign rating, and individual companies. The source notes that normally a company's rating cannot be better than the sovereign rating because the country's overall economic and political stability forms the backdrop for any company operating within it.
Right. And these ratings are on a scale, investment grade versus speculative grade.
Exactly. The source mentions investment grade, which signifies good fundamental financial health and relatively low risk of default, versus speculative grade, often called junk, which indicates a higher risk. A higher rating within the investment grade category means less perceived risk for the lender.
And less risk means a lower markup, cheaper borrowing.
Precisely. Lower markup over the benchmark rate like LIBOR, making the ECB cheaper for the company.
So what was India's sovereign rating according to the source at the time it was written? How did that affect borrowing costs?
The source states India's rating was a low of one notch above the last in investment grade.
One notch above the last, so just barely investment grade.
That's how the source puts it. India was considered marginally as investment grade. It wasn't rated as high risk, speculative grade, but it was right at the bottom rung of the safer investment grade category. This would imply Indian companies, even good ones, might face somewhat higher markups compared to companies from higher rated countries.
And did the source list specific reasons the rating agencies gave for India's rating being relatively low at that time? Why only marginally investment grade?
Yes, it details several reasons cited by the agencies. A major one was the high fiscal deficit, specifically the combined fiscal deficit of the center and states put together being over 10%. The agencies viewed such high levels as unsustainable in the long run.
That links back directly to the preconditions for convertibility we discussed earlier, needing manageable fiscal deficits. It impacts borrowing costs, too.
It absolutely does. Another reason cited was the high levels of public debt, all liabilities of central and state governments, to GDP ratio of over 70%.
High government debt. Why is that such a concern for rating agencies?
Well, the source notes that these agencies see high public debt levels as potential trigger points of an internal crisis, and it explicitly mentions the examples of Greece and Ireland, where high public debt led to severe economic problems and bailouts. The fear is that a government might struggle to repay its debts, leading to instability.
Okay. Any other reasons for the lowish rating?
Yes, the source mentions the near absence of fiscal consolidation, meaning a perceived lack of sufficient concrete action or progress in bringing down that deficit and debt, and also the slowing down of the reform process more broadly was cited as a concern.
Now, the source notes the Indian government wasn't happy with this rating.
Correct. It says the government has protested against the rating, likely arguing that it didn't fully reflect India's underlying economic strengths or potential. However, the source also acknowledges that these rating agencies are known for their independent and unbiased thinking.
And whether the government likes it or not, these ratings have real consequences.
Absolutely. The source emphasizes their ratings have global acceptability and the basis for deciding the markup for ECBs, besides also influencing overseas investment decisions more broadly. So these ratings have real-world consequences for how easily and, crucially, how cheaply Indian entities can borrow abroad and attract investment. Official protests don't change the market's reliance on these ratings.
Okay. So, with this framework of ratings and markups in mind, how does the RBI actually regulate ECBs under FEMA? There are specific rules, aren't there? It's not just completely open?
No, it's managed. Under FEMA, the RBI sets the parameters. A key feature is the automatic route. Companies can raise a certain amount of ECBs under this route without needing prior case-by-case approval from the RBI.
And how much is that automatic limit, according to the source?
The source states this limit is up to USD 750 million. That's a pretty substantial amount a company can potentially borrow internationally without facing regulatory delays for approval.
Are there conditions attached even to these automatic route ECBs? Or is it just about the amount?
No, there are conditions. The source lists a few key ones. They are subject to a specific maturity period stipulated by RBI, meaning the loan can't be too short-term. It has to be for a minimum duration set by the RBI.
Okay, minimum loan length. What else?
They also have end-use restrictions. This is important. The company borrowing the money must declare the specific purpose for which they are borrowing, say, importing specific machinery, funding a particular infrastructure project, refinancing an older loan, and the funds can only be used for that stated purpose. You can't just borrow overseas for general working capital under this route, usually.
And there's a crucial restriction on bringing the money back into India and converting it to rupees, isn't there? You mentioned that earlier connection to managing inflows.
Yes, this is a very significant point under FEMA's management framework for ECBs. The proceeds from these borrowings have to be parked overseas and will not be allowed to be converted into rupees for bringing it back into the domestic economy.
Why is that rule there?
It exists largely to prevent huge slugs of foreign currency, borrowed by multiple companies, from suddenly flooding the domestic foreign exchange market all at once. That could cause the rupee to appreciate too quickly and unpredictably, hurting exporters, or create excess liquidity issues in the banking system. Since the money is often borrowed in foreign currency to pay for things in foreign currency, like imports or overseas projects, the idea is to keep it ring-fenced outside the country's direct domestic financial system initially.
Makes sense from a management perspective. Is there an overall cap for the whole country on ECBs?
Yes, the source mentions an overall country-level ceiling of USD 35 billion for ECBs. This puts a limit on the total amount of international borrowing by all Indian companies combined in a given period. It's another tool for managing the country's overall external debt exposure and vulnerability.
Does the source mention any limitations?
Yeah.
Can any Indian company just go and borrow $750 million overseas?
It does note a practical limitation. The source says that only reputed companies can access the ECB route. This implies that smaller companies, those less well-known internationally, or those with lower credit ratings, might find it difficult or impossible to actually secure these international loans, even if they fall within the regulatory limits. Lenders still need to be willing to lend.
Right, and this borrowing, these ECBs, they add to the national debt figures.
Yes, the amount raised as ECBs by Indian companies is reflected in the external debt of the country because it represents money owed by Indian entities to lenders outside of India.
Okay, so ECBs are one major way for companies to get foreign currency funds, mainly debt. Are there other routes mentioned in the source for raising foreign capital, perhaps equity?
Yes, absolutely. The source discusses yet another route for Indian companies to raise foreign currency, this time tapping into international equity markets
Great.
through the issuance of American Depository Receipts, ADRs, and Global Depository Receipts, GDRs.
ADRs and GBRs.
Mm-hmm.
Okay. Why were these necessary? Why couldn't Indian companies just list their shares directly on, say, the New York Stock Exchange or London Stock Exchange back then?
This route was developed specifically in the absence of convertibility, particularly full capital account convertibility, since foreign investors couldn't easily buy and hold Indian shares directly using rupees due to currency controls and regulatory differences, and Indian companies couldn't easily meet all the requirements to list their shares directly abroad. They needed a mechanism to access the global capital market by issuance of shares indirectly. ADRs and GDRs provided that bridge.
So how does that mechanism work? How do you issue a receipt instead of a share?
The source explains the process pretty clearly. First, the Indian company issues actual shares, just like it would for the domestic market. But instead of selling these shares directly to foreign investors,
They do what?
they offload the shares to an international depository. This depository is typically a large international bank like BNY Mellon or Citibank. The depository acts as a custodian, holding the underlying Indian shares securely in India.
Okay, so the depository bank holds the actual Indian shares. Then what happens?
On the basis of these shares held in custody, the depository then issues depository receipts. These receipts are certificates that represent ownership of a certain number of the underlying Indian shares. For example, one ADR might represent 10 underlying shares. These receipts are then sold, just like shares in the overseas market, to international investors in dollars or euros.
So the foreign investor doesn't hold the actual Indian share certificate, but they hold this depository receipt, which represents it and is denominated in foreign currency.
Exactly. The source says these receipts are akin to a share, have similar features, but are not shares as it does not confer voting rights to the holder. That's a key difference. So the foreign investor gets the economic exposure they benefit if the share price goes up. They receive dividends passed through by the depository, but typically they don't get the voting rights that come with directly holding the equity share in India.
Okay, so like a share, but without the vote. And these receipts can be traded easily overseas.
Yes, that's the point. They can be listed and traded at the global stock markets just like the shares. So an investor in New York can buy and sell an Infosys ADR on the NYSE just like they trade shares of IBM or Google.
And the naming convention, ADR versus GDR.
Simple. Receipts specifically issued and traded in the United States are called ADRs, American Depository Receipts. Those issued and traded elsewhere, maybe London, Luxembourg, Singapore, are called GDRs, Global Depository Receipts.
The source notes that most of the reputed Indian companies are enjoying listing at the global stock markets through the ADR route, suggesting this became a pretty popular and successful method for larger Indian companies to get international investor exposure and raise foreign capital.
It was, and still is, very important. And the benefit for the companies isn't just raising capital. The source points out it also allows them to test international markets for their inherent strengths, competitiveness, and global acceptability. Well, listing via ADR/GDR means the company has to meet certain international disclosure standards. Its financials and performance come under the scrutiny of global investors and analysts. It provides valuable benchmarking and can enhance the company's reputation globally.
Now, unlike the automatic route for a lot of ECBs, ADR/GDR offerings require a higher level of approval back in India, don't they?
Yes, that's an important distinction. The source states clearly that ADR/GDR offerings are not on the automatic route and require prior approval of Ministry of Finance, Government of India. This indicates a stricter regulatory oversight for companies tapping directly into global equity markets this way, compared to borrowing via ECBs.
Okay, so we have ECBs, debt, and ADRs, GDRs, equity-like receipts. Is there a third route mentioned in the source for companies accessing foreign funds?
Yes, there's one more key instrument discussed. Foreign currency convertible bonds, FCCBs, sometimes they are also called FCCNs.
Notes. Foreign currency convertible bonds, FCCBs. What are those? Are they debt or equity?
They are described as quasi-debt instruments issued by Indian companies in foreign currency. So they're a bit of a hybrid, sitting somewhere between pure debt and pure equity.
How do they work?
They function initially like a bond. It's essentially a loan from the investor to the company, denominated in foreign currency, like dollars or euros. The bond may or may not have regular interest payments, coupon payments. But the convertible part is the key feature.
What does the convertible part mean?
It means these bonds offer the investor the option, not the obligation, but the right to have the bond converted into shares of the issuing Indian company at a predetermined rate at the discretion of the investor.
So if the company's stock price does really well after the bond is issued.
Exactly. If the stock price rises significantly above the preset conversion price, the bondholder can choose to convert their bond into shares of the company, potentially making a nice profit from the stock appreciation. If the stock doesn't perform well, they can choose not to convert and just hold the bond as a debt instrument, hopefully getting their principal back at maturity and any interest payments along the way.
So the investor gets the potential upside from equity appreciation while having the relative safety of a bond if the stock doesn't rise. Seems like a good deal for the investor.
It can be attractive, yes, and for the company, issuing a convertible bond might allow them to borrow at a lower interest rate than they would have to pay on a straight non-convertible bond, precisely because the investor gets that added value from the conversion option.
And how are FCCBs treated under FEMA? Do they need approval?
Under FEMA, the source notes that issuance of FCCBs by Indian companies is allowed subject to amount and minimum maturity stipulation under the automatic route. So, for this specific hybrid instrument, there is an automatic approval path available, similar to ECBs, as long as the issuance fits within certain RBI-defined limits regarding the amount raised and the minimum duration of the bond.
Okay, so that's quite a range of options then. To bring it all together regarding how Indian companies can tap into international capital, the source summarizes the main avenues opened up by the post-reform framework, right?
Yes, it concludes that the Indian private corporate sector can access the international market either as ECBs or ADRs or FCCBs or a combination of all. These are the primary regulated channels established since the reforms of the early 90s, enabled by FEMA to allow Indian businesses to raise crucial foreign currency capital and integrate much more effectively with global financial markets. It was a massive departure from the severe limitations they faced under FIRA.
Absolutely. Looking back at this whole deep dive, we've really traced a monumental shift in India's economic policy, haven't we? Moving from that tight, restrictive control of foreign exchange under FARA, a system built on preventing and regulating,
to the much more liberal framework of FEMA, which focuses instead on management and generally permitting transactions, facilitating rather than blocking.
And this transition, this move from FARA to FEMA, was absolutely essential for enabling India's broader trade liberalization and integration with the global economy that started in the 90s.
We also explored the complex concept of rupee convertibility. We understood the freedoms it brings to an economy and its participants easier trade, investment, travel, but also the significant risks it entails, like vulnerability to crises or capital flight.
And we saw that India has achieved complete convertibility on the current account, which is a huge deal for facilitating everyday trade and services, although there are still a few specific notable exceptions where government or RBI authorization is still required.
Right. And we clarified that India does not currently have formal capital account convertibility. The freedom to convert rupees to foreign currency for overseas investment is still managed. However, there has been very significant easing of restrictions on capital outflows, particularly for Indian residents' overseas investments and for companies borrowing or raising capital overseas.
This easing allows India to get many of the benefits of greater financial integration while crucially retaining a degree of policy control and the flexibility to adjust those controls if economic conditions warrant, as we saw with the remittance limit example.
We also touched on the ongoing debate about moving to full SEC. We weighed the arguments presented in the source, the lack of immediate pressure, the lessons from other countries like China, suggesting it's not strictly necessary for growth or investment.
Against the view also presented in the source that full CAC is probably an inevitable step in India's long-term integration journey, partly because maintaining partial controls becomes increasingly difficult and leaky over time in a globalized world.
And finally, we detailed the practical mechanisms created under this new, more open framework, the tools Indian companies can now use to access vital foreign currency funds for their growth and global operations. External commercial borrowings, ECBs for debt, American and global depository receipts, ADRs/GDRs for quasi-equity, and foreign currency convertible bonds, FCCBs, as a hybrid option.
Understanding this complex shift from a relatively protected, insulated economy to one that's increasingly integrated with global trade and finance really is fundamental to grasping modern India's economic landscape and its place in the world. This material provides a clear roadmap of that critical transformation, specifically in the realm of foreign exchange and international capital flows.
It certainly does. It lays out the what and the why quite effectively.
And this entire process, as laid out in the source material, it really makes you ponder the strategic choices countries face as they open up, doesn't it? India's path has been deliberately cautious, gradual, aiming to mitigate those risks we talked about while still reaping the rewards of integration.
Mm-hmm. That cautious, calibrated approach comes through strongly.
Yet the source also posits that full convertibility is ultimately inevitable. It leaves us with a fascinating question to think about.
Which is?
Well, what might be the triggers? Perhaps domestic economic developments reaching a certain maturity, maybe shifts in global finance making it more necessary, or even changes in geopolitical dynamics that eventually lead India to take that final step towards formal, complete capital account convertibility. And given India's cautious approach so far, how might that final phase of the journey be managed? That's a truly interesting thing to consider as you continue exploring this topic.
Definitely food for thought. The when and how of that final step remain open questions.
Thanks for joining us for this deep dive into India's significant economic transformation regarding trade and foreign exchange. We really hope you feel much better informed about these pivotal changes.